Thank you for joining us on the Retirement Income Source Hour, where it's always going to be about investing for income the old-fashioned way. What do I mean by investing for income the old-fashioned way? Well, first of all, it's nothing new. Back in the 60s, 70s, and 80s, it was very common for retirees to use dividend-oriented plans. And for some reason, after the 80s and 90s bull market, people started changing and started focusing more on growth. And reason why is because it's a lot easier just to invest your money in one place, not think about that. You got to get income first and growth too. So we sell growth and we call that income. And so for many, many years, people were actually, back then, were actually living on dividends, or they were investing in CDs. I don't know if you remember this, but CDs used to pay a significant amount of interest for many years. It was a divorce dream a retirement dream come true. And so when people were retired, they retired a lot more comfortably because they knew back then it was common advice to just live off your dividends, and then somehow we just kind of swept it under the rug after the bull markets of the 80s and 90s. We really didn't need to invest that way, even though that way, believe it or not, still is better than the alternative. Because the problem is most people think that the markets are always going to go up. I hear that a lot. They'll say, well, the market's going to go up. Why in the world should I have to worry about it? I said, well, you won't worry about it until you have to worry about it, right? Once the markets do come down, if they come down significantly, then you have no other option but to postpone either retirement, go back to work, or cut back on your spending. Well, I don't know about you, but I don't like those three options. If you're going to invest in retirement, you need to be prepared for worst case scenario, not best case scenario. And so many people are not as diligent today about retirement is because that's not the way the retirement advice has been given when you speak with most financial advisors. And this is nothing against financial advisor. I'm a financial advisor myself. It's just our philosophies. We decided we're going to focus more on income first, growth second. If I focus on income, I will get growth. Why? Because I can't control the growth column, because after all, aren't we going forward? When you invest and go into retirement, it's about going forward. It's not about looking back. All we can do is learn from looking back, but we going forward. Going forward means you got to rely on a certain return. If that return doesn't cooperate, and then you were hoping it was going to cooperate, and I can tell you, and I know hope is not a strategy for income. So just so that way you know, today we're going to be talking about a particular income vehicle, and it's very commonly talked about today, more so than I've ever seen it before. And keep in mind, I am neutral when it comes to talking about annuities, but from time to time I still like to have a conversation about annuities here on the radio, because most of you probably are being approached by them. You probably own them. You're probably, maybe some of you are pleased with them. Maybe some of you are not. You don't like them anymore. Maybe there's some problem with that annuity or whatever. And so today we're going to be talking about the annuity upgrade opportunity. And what do I mean by that? Well, typically, if you think about it for a moment, annuities are interest rate driven. When interest rates are low, annuities are not attractive. And I'm primarily talking about fixed annuities. If you go to a bank and you invest your money in a CD, you're probably going to be getting, 0.5% to 1.5% on average, back in 2021. Well, since then to now, with the exception with some of the lowering of interest rates here recently, the interest rates have jumped up in the 4% range. Well, I know most of you, I'm hoping, have taken advantage of upgrading your CDs to those higher rates. Why not take advantage of them while they exist? Well, it's the same way is true when it comes to fixed or even sometimes fixed index annuities, which is probably the most commonly sold product out there today in America. Matter of fact, everybody's selling it on every corner. They even put themselves off to be a fiduciary or the best interest type advisor and so forth. And what I find, what I don't like about them is putting too much into an annuity. If a client doesn't want an annuity, then when they work with us, then they don't get an annuity because I don't need an annuity to generate income. So with that being said, but annuities do have some appeal depending on the risk comfort of the client that we speak with. Ignoring the annuity is also equally important to know because they're not a bad vehicle in today's high interest rate environment. What I find is a lot of times people don't know what they don't know. And they don't quite understand them, or they think they're too complex. And I've actually had people tell me that they're so complex they really don't want to talk about them. And so all I do is basically bring it up into discussion. And the only reason why, not to promote it, just to let them know that, I'm first of all, I'm trying to inquire and finding out why they dislike them. And there's a lot of annuities out there I don't like neither. And sometimes it's always the same response. It's either I don't want to give up my annuity, my money's locked up forever, or I hear the word too many fees. Well, those two type of annuities do exist, but those are not the type of annuities that I'm going to be talking about today. The type of annuities we're talking about today is a lot simpler than that. So with that being said, before we dive too deeply into annuity upgrades and share with you some stories and stuff of why it makes sense, especially and again, this is for people that have existing annuities out there and are not aware that they can upgrade them, including and sometimes being capable of paying the penalty, as long as the penalty is to your advantage and not disadvantage. I know you heard the word penalty, and I'm not here to tell people to pay a penalty on their annuity, but once they understand that they pay a penalty and they can also upgrade it and get the bonus from an existing annuity that will pay them, will recover the penalty, then it sometimes may make sense. Again, it depends on what they're trying to achieve. Most people buy annuities for one reason, safety or income. That's the only two reasons they buy them. And that's the only two reasons they should buy them. If they need income, then you're probably not going to beat an annuity. Not any tool out there that I know exists today, bonds, stocks, real estate, none of them will do on an annuity because your balance goes to zero in a CD, your balance goes to zero in your stocks and bond portfolios, and they quit paying you the income that you were actually taking out. But within an annuity, you cannot outlive the income, because that's called longevity insurance. So with that being said, if you would like to know more about how to upgrade an annuity and does it make sense, you want to talk to a true fiduciary, because a true fiduciary, like myself, has to make sure it's not just in your best interest, but also the insurance companies now require a comparison sheet to be able to make sure that the upgrade makes sense. In other words, they're also, again, a second set of eyes, not just the financial advisor themselves. So if they don't think it makes sense, then they won't allow you to upgrade. So that saves you from that. But what I find in our industry today is there's a lot of advisors that are somewhat misleading on how they basically get them people to upgrade an annuity, and without sometimes even the insurance company even being aware of it, because the agent has to do their due diligence, and so they'll have some loopholes, so to speak, that they'll use in order to be able to make that change, and that's and believe it or not, that can get them in trouble in the future. But with that being said, I'm going to explain to you why an upgrade can make sense, because a lot of times when people put money into an annuity, the purpose of that is, again, safety and income, but most importantly, how long do you want that safety? I mean, if you can get to safety for the next 10, 15, or 20 years, the safety of your money, and generate a better and higher return than you could have if you were in CDs, or even in a lot of corporate bonds and so forth, why wouldn't you want at least to have some of your money in just exactly the way I explained that? Well, a lot of people don't understand that an annuity in that context is nothing no more than just like any other investment. So you can, after the maturity period, just like a corporate bond, a long-term corporate bond, maybe 3, 5, or 10 years in length, you can take the money out and reinvest it the same way you can with a particular type of annuity that I'm talking about. And the opportunity is starting to diminish slowly but surely, because as long-term rates eventually start coming down, which they haven't yet, and I'm talking particularly the 10-year T-bill, then you're going to probably still see annuity rates a little bit higher today than what they were just 3 years ago. I got some questions I'm going to ask you about whether it makes sense or not. And I got to have a statement in front of me in order to be able to tell you whether it makes sense. Because there's benefits and stuff that are also paid out. Again, remember I told you the insurance company is looking at this as well, and this is something that has to be completed, and they're ultimately going to make the final call. It doesn't mean you can upgrade. The company could turn it down and reject it, just like a mortgage loan application. So you have to keep that in mind. So, but again, if it makes sense, people should be upgrading while the rates are as high as I've seen them since 2007. So if you would like to learn more about that, then I would encourage you to call our office at 888-930-1080. Again, that's 888-930-1080. And that you'll set up a phone call with myself, and we will actually cover you can have that statement on the phone, schedule that appointment and so forth, and we can actually cover that and tell you whether it makes sense. Just trust me, rates are much higher than they were 3 years ago. When most people that we run across that needs to upgrade their annuities, if the word is if it makes sense, typically have on their annuity for at least 3 years, if not 5 to 6 or 7 years. And upgrading it, all it's going to do is just going to increase your return. I don't know about you, increasing return on my money can be very beneficial. So we'll talk more about that here in just a little bit. And I thank you for tuning in. This is the Retirement Income Source with Tim Sparks. We will be right back. Welcome back to the Retirement Income Source with Tim Sparks, your host, and our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky. Today we're going to be talking about the annuity upgrade opportunity. And what I'm specifically talking about is certain types of annuities, not the ones that sometimes people reject or they're opposed to. For many years, annuities have had a lot of criticism. Particularly, one gentleman, as y'all know, was Fisher. Fisher doesn't like annuities, and he shouldn't like annuities. You got to keep in mind he's a multi-millionaire. If I had that kind of assets myself, I wouldn't care about having annuities myself. Annuities do certain things that other instruments do not. One of them is they pay an income you cannot outlive. The problem is the income may not keep up with inflation if you was to choose that type of benefit, and that income paid that out to you for 20 or 30 years, because it's the same amount of income. It doesn't change. It just stays the same. Typically the payout rates on these particular annuities are much higher. Payout rates today, you can get, and I'm talking about an income benefit. This is where your principal will be more than likely spent. There's no way around it. I don't care what type of illustrations that guys show out there today. I'm talking specifically just an income-based annuities, and these have a place for certain clients that want income and they want safety. And I don't care who the client is. I mean, you got to keep in mind, people, that doctors, lawyers, CPAs, there's a lot of people that owns these tools, and they own them for a reason. And I'm just choosing those vocations because a lot of people respect those vocations, but at the same time, not all annuities are bad. And so I don't have to have an annuity to generate income for our clients, but some people do like the safety of them. So if you take the income benefit of a particular annuity, the income benefit today on, let's just say you had $500,000 and let's just say this is part of a income plan for a particular person. And keep in mind, this is all I'm doing is I'm just talking numbers here today. Okay, so if you put in a $500,000 with a particular company today, that company will pay you $40,000 to $45,000 a year for the rest of your life if you're a single person. And if you think about it for a moment, there's no instrument out there that can actually do that and guarantee you that. The word guarantee, and that's, of course, that's based on the paying claims of that particular insurance company, but they pay that for life. It's like a pension. It's like a Social Security. I mean, most of us are familiar with Social Security. Well, that's kind of what that is. It's a form of a pension, and it's guaranteed and insured by the government. Here, I'm talking about a personal pension, and it pays you $45,000 a year. Well, that's an 8 to 9% guarantee. And to be quite honest with you, I'll tell you a place where I've seen them, and it's not that I would have recommended them, but I've run across people that come in here, they're taking out 8 and 9% out of their accounts each and every year, running the risk or going to run out of money in about 15 to 18 years. So if they keep that up, then they should have probably purchased the annuity, because at least they wouldn't have to worry about running out of, they may run out of principal, but they won't run out of income because they'll keep getting the income paid to them. And so keep in mind, we're talking about specifically income base, and there is particularly people out there that like a certain amount of income, and they like that income to be guaranteed. And the only way you can get guaranteed income today is through an annuity. Real estate, stocks, bonds, it doesn't matter what you've been told. There's nothing out there that guarantees like an annuity. It's similar to like pensions, and it's similar to like Social Security. They're all kind of, you can put them in the same bag, and they're about the same type of guarantee. And again, that's based on the paying claims of that particular insurance company. So if that makes sense to you, in other words, what is an income benefit? I mean, you just want an income, like a pension, like you're just investing a certain amount of money just for the purpose of guaranteed income. Keep in mind, people, this is not a preservation of principal type instrument. The rates are at an all-time high, at least they have been in the last 15 years that I have seen. And when rates are up, also is the income guarantees. Then I want to get a report in your hand called Annuities Income for Life. And you can get that by calling 888-930-1080. Again, that's 888-930-1080. And we will mail this to you or email it, whichever you prefer. Again, that's 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks, your host. And today we're talking about an annuity upgrade. Why now is the best time? Rates were very low several years ago, but now they're much higher. I mean, think about it. You're trying to get a return on your money without taking a lot of market risk. Actually, you're eliminating market risk if you're in a fixed-like type of annuity instrument. You have two different types of fixed annuities out there today. You got one fixed annuity today that pays just a set amount of interest like at a CD in a bank, but typically they pay more than CDs and they pay longer. And typically we're seeing up to 5.5% for as long as 10 years. By the way, there's no fees in that particular type of annuity. So if I had, $1 million today invested in this particular annuity, and I wasn't wanting any risk whatsoever, and I didn't want to pay an advisor any fees whatsoever, then you can draw $55,000 a year. That's right, $55,000 a year, just under $5,000 a month. And then in 5 to 10 years from now, depending on the maturity period you choose, you will get your $1 million back. You can take it back out, reinvest it, put it in stocks, but I don't care what you do with it. But the key is understanding the concept of what I'm talking about when it comes to a fixed annuity. An income-based annuity, like I was sharing with you earlier, is for the purpose of a lifetime benefit. And you got to keep in mind, there's always gotchas, right? There's pros and there's cons when it comes to annuities. And whenever it comes to an income-based annuity, the income is the benefit, so the insurance company is insuring longevity risk. So when they do that, that means your returns on your money is going to be less. But no worries, you don't have to worry about outliving your principal, because your principal can go to zero. That's right, it can go to zero. I don't care what you've been quoted, promoted, or whatever, in illustrations wise, but the income or the balance, because you took out such a large withdrawal out of that per year, and it's guaranteed for life, means that balance is going to go to zero as short as 12 to 13, maybe 14 years. But that's okay. Hopefully that was explained to you that in that context. In other words, you were looking for a pension-like income, and that's why you purchased it. But if you were looking for preservation of principal, you shouldn't have bought that annuity. That was the worst annuity you could have bought. And also, if you were looking for income that was going to go up with inflation, then that would have been the worst vehicle to buy. So keep in mind, it's you probably know some people that have got pensions over years that that work for particular companies, some corporations, and so forth, and the income never increases. So we're not talking about like Social Security where you get some increases. We're talking about something that stays stagnated for as long as you live. So if you start taking your income of $3,000 a month today at age 65, at the time you get to age 90, it's still going to be $3,000 a month. So that does not keep up with inflation, because you're going to need more income than that. And so that vehicle in of itself is not there to try to combat inflation. But fixed interest annuities are paying some considerable amount of interest right now. It's like an opportunity that's going to come and go. My dad always told me, he said, opportunities are never missed, just somebody else takes advantage of it. Well, sometimes if we just stay oblivious to information, sometimes things do kind of just, like my dad always told me, said, son, about 45 to 50% of the people get hit by the train. The other 45% of the people watch the train, and only a very few people get on the train. Well, when it comes to opportunities, I would encourage you to get on the train, at least find out. You can still say no. I mean, it's just like buying a car. You don't have to buy a car just because you showed up to the car dealership. It's the same way here. Like you're shopping for tires. You don't have to buy tires from that particular tire place that you wind up was doing your research on. So keep in mind, it's all about making more returns on your money. If you can do it with no risk, why not take advantage of it? Because most people would consider 5.5% a pretty good return today. Matter of fact, that's better than what the average inflation is. Even if you take inflation of 4%, I'm beating inflation with taking no risk. So again, that's 5.5%. That's about where they're at. Pretty cookie cutter. There's not a lot to talk about other than their fixed rate of interest for a certain period of time, anywhere between 3, 5, or as long as 10 years. Well, with that being said, if you would like to know more about Income First Method, what this show is all about is helping people to have growth and income. But income should be the first thing you're looking for. In other words, if you get income, you get to keep the farm. And therefore, your farm will go up in value over time. Or real estate, using an analogy, you can invest the same way. I want to get a book in your hand called The Retirement Income Shift, written by your host, Tim Sparks. Amazon bestseller after 1 week of its release. And I got a free copy for the first 5 callers of today's retirement income source. Call 888-930-1080. Again, that's 888-930-1080. And we'll mail this book out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. You're tuned in to the Retirement Income Source with Tim Sparks. We'll be right back. You're tuned in to the Retirement Income Source. We thank you for listening. This is Tim Sparks, your host, and our show is sponsored by Sparks Financial Group, a firm right here in the heart of Bluegrass, Lexington, Kentucky. Today, we're going to be talking about the annuity upgrade opportunity. A particular annuities I'm talking about works very similar to like a bond. When interest rates are up, so are the yields. You ask anybody right now, they're kind of excited for the first time, especially in the last couple years. Money markets, your short-term instruments, and mid and long-term instruments are finally paying a little bit of income. And I know a lot of you are probably excited. Well, annuities typically pay more income than the alternatives. The alternatives being CDs, actually even corporate bonds. Corporate bonds they're guaranteed by the issuer. The issuer could be Coca-Cola, it could be Pepsi. But when you own an annuity, there is no fees with this particular type of annuity. And, rates are up right now. So it's a great time to take advantage of them. So no fees, rates are in the mid 5s, and take advantage of them while they still last. Because I don't know about you, if I can earn $50,000 to $60,000 a year and nothing but just spending pure interest, and my money is going to be returned to me 3, 5, or 10 years from now, I'll buy that all day long, especially if I'm more of a safetier type personality. We run across a lot of people that are risk averse, and this type of annuity can actually benefit you and take advantage of that while they still last. So I recently upgraded, and I wanted to share with you some stories about some people where it makes sense. And maybe if you're going down the road right now, and if you purchased especially an indexed annuity, it's a safe instrument. You don't have to worry about market risk. You can make the gains when the markets go up. You don't make all the gains, and when the markets go down, you keep the gains that you made from the year before. The gains are annualized and so forth. But there's a lot of same type of annuities. They were purchased 3 or 4 years ago, or 5 or 6 or 7 years ago. Then you should be encouraged to probably upgrade that. Why? Because your returns should more than double compared to what you're getting right now. Why not do that? I mean, to me, it's a long-term instrument. You're going to probably keep it there whenever it renews, and when it renews, rates may be down lower than what they are now. So why not take advantage of it while it still lasts? And so I had a particular client here recently that had purchased an annuity about 4 years ago, and they happened to have a return of premium on theirs. And market value adjustments, this is just another way of saying that the penalties are pretty steep today on annuities. Here in about 3 weeks, we'll be replacing this annuity, and the reason why is because the annuities today are paying 2.5 to 3 times more on the cap side of the S&P 500 than they were just 3 years ago. And what do I mean by that? Well, when you have a fixed indexed annuity, you don't make a return every year. You can get a year where you don't make any return at all. So it has a floor of 0%. And then it has a cap. That cap can be 3 to 4%, and that's pretty much what this person had. They had a cap of 3% because this annuity that they purchased 4 years ago, today they can get the same cap as high as 12 to 15%. That's where the caps are at. Why are the caps higher today? Interest rates are higher. So if the interest rates are higher, that means the caps are higher. So in the good positive year, the client can make up to 12, 13, maybe 15% on a good given year. That does happen. We have clients we're meeting with today in the last 12 months, the last 18 months, have averaged anywhere between maybe 13% on the low side, as high as 22% on the high side. And when they get the return, they get to keep the return. That's what, and it's got a floor. The floor means in a negative year, that means you don't have to worry about participating in market losses. It's another way to be able to generate more returns. The negative is it's got a zero floor. Floor means zero means you're only going to earn 0%. Well, compared to what? So think about this for a moment. Let's just say the next 12 months, the market goes down 20%. Well, if you have 100,000 and you're in an S&P index fund, you're down to 80,000. Well, since you had a floor in this particular type of annuity, you still got 100,000 because you didn't participate. You were linking your gains because the insurance company's the one's taking the risk, not you. You were linking your gains to the S&P 500, but you didn't have to participate in the loss, so you still got 100,000. So a zero, in that sense, was better than taking a 20% loss. That's what we mean by floor. Well, that's not why you buy the annuity compared to the S&P index fund, because the S&P index fund over 10 years will probably outperform that particular type of annuity if it has a low cap rate. Most low cap rates today are 3 to 4%. I'm talking about not today, but I'm talking about 4 years ago, from like 2012 to 2021. Cap rates have been pretty low. Well, today they're anywhere between 10, 11, 12%, 13, 15%, and some other contracts and so forth. And so if you think about it for a moment, good years, you make more than you would have if you would have been in another type of lower cap instrument. So I don't know about you, if I had in a good year, if I can make, let's just say 12%, and because I've got a cap of 12, I may have made, the market may have went up 20, I only get 12. The company doesn't give me the other 8 because I'm not in the market, so they cap me at 12%. But if I had equally the type of contract where I'm in a lower type of annuity and it has a lower cap, and I'm capped at 3 or 4%, and the market still went up the same 20, I only make 3 or 4. I don't know about you, but I'd rather make more in the good years. That's the reason why the upgrade may make sense. And a lot of people don't realize that those annuities upgrades have actually have been available now for the last 16 to 18 months. So with that being said, if you would like to get an assessment of your particular annuity and want to know, can you upgrade your annuity? Does it make sense? Keep in mind, there's 2 sets of eyes whenever you upgrade an annuity. Not just me, the fiduciary, but also the insurance company also takes the same perspective to make sure it makes sense, because there's a form that you have to fill out, and it's a comparison form, and so they do their due diligence. So there's that way the agent is not doing something that may not be in your best interest. That's why they're doing that today. So that's kind of glad they put that out there to protect people from agents out there, just so that way they can make some extra compensation. And you can get that analysis if you call the office. You schedule an appointment with myself, 888-930-1080. Again, that's 888-930-1080. And what we'll do is we will set up a phone call, and from the phone call we will have you come in our office, and where we can actually discuss whether it makes sense or not. Again, have your statements prepared whenever we have that phone call, or it's really we're really wasting our time, because again, it's just in a comparison of analysis to make sure that you're not leaving money on the table, because most people, if they got safer money, like the type of annuities we're talking about, why not upgrade them if you can? So you're tuned in to the Retirement Income Source. This is Tim Sparks, and today we are talking about annuity upgrades. Why now is the best time? Well, rates are higher. 3 years ago, rates were close to 0%, 0 to 1%. And what I'm specifically talking about was money markets, short-term bonds, and also CDs. Well, today, interest rates have went up, long-term rates are up, and when long-term rates are up, so are fixed annuity rates. And fixed annuity rates are paying more than they were just several years ago. So if you can double your return with taking the same amount of risk you're taking right now, why not at least take a look to see if you can do that? I've had people come in and didn't know that they can get out from underneath even a penalty. Now keep in mind, it's not always suggested to pay a penalty. And I've run across people that will not pay a penalty, even if it's 1% of their account value. And I run across a guy one time, and he's kicking himself in the chin for not doing it. That he had about $950,000 in some annuities he's had for like 30 years. These were variable annuities. Again, variable means he's actually in the market when he owned them. He had a year left on his contract period. I think it was a 7-year annuity. He had 6 years. He was 6 years into it, and he had 1 year left. And I did everything I can do to encourage him to get out from underneath that annuity, because I told him the fee in of itself was costing him about 3.5%. And that's why I don't like them particular type of annuities. Not all annuities are created equal, but this one had a fee of around 3.5%, and the penalty was only 1. I told him, I said, you would save yourself 2.5% just making a change, and he didn't see it that way. Well, guess what happened? This was in 2018. By the end of the year, I don't know if y'all remember, the markets took about a 20% hit, and so it looked just like Groundhog Day all over. We were going to have another correction, and so by that time, this guy's account value had dropped $130,000, and if he would have just made the change when we suggested, he would have prevented that from happening. Keep in mind, people, that sometimes when I know I get it when you talk to salespeople, you're afraid that they're out there just to to make a sale, and at the end of the day, if you do your due diligence, there's if you buy something or if you invest your money in anything, somebody's making money on you. I don't care where you got it. If you was a stockbroker, or if you were with a financial planner, or if you're with a fiduciary, it doesn't matter. Everybody's making money on your money, and so I guess it's another way of looking at it. It's a necessary evil of investing, right? To some degree, you're going to put your money somewhere, and it doesn't matter how you try to convince yourself that you're not paying fees. Even if you put your money at Vanguard, there is a certain amount of risk you still have to take, even from a discount perspective. So, and typically the compensation on annuities today is nowhere near as high as they used to be. The insurance companies have been reducing that compensation. I know people will tell me, well, they just after to sell and they get rich. Well, you heard that from a particular stockbroker who used to write articles in Forbes magazine, told you that and convinced you of that. And so they were so tough on annuities that you agreed with them without even taking any initiative to find out whether that was a true statement or not, or what was the motivation of the person who wrote the article. Well, the person who wrote the article thinks you should actually pay them 1.5% to manage your assets for the next 20 or 30 years. Well, I can tell you right now, you're going to pay quadruple for that type of advice than you would have if you would have actually purchased an annuity, because annuities do not pay that much in commissions like they used to. Again, at the end of the day, it's not necessarily compensation, but what are you trying to solve? You're trying to solve the problem of income, or you're trying to solve a problem of safety or something like that. You're going to invest your money. Where are you going to invest it to be able to keep, to be able to get you the amount of risk that you're looking for, which actually particular type of annuities that our clients get for the ones that are okay with annuities. Again, I'm unbiased when it comes to annuities and very neutral with them. Don't need an annuity for income, but there is particular clients out there that like some safety in their investment portfolio, and an annuity can actually come in and fill that void. If you would like to know more about income first methods, growth methods second, in other words, income growth, not growth then income, but income then growth, then I'd like to get a book in your hand. New book just came out in October, Amazon bestseller, Retirement Income Shift by your host, Tim Sparks. And I got a free copy for the first 5 callers of today's retirement income source by calling 888-930-1080. Again, that's 888-930-1080. And we'll mail this to you if you're, again, one of the first 5 callers, free no obligation book, 888-930-1080. You have been listening to the Retirement Income Source with Tim Sparks. We will be right back. Welcome to the Retirement Income Source. This is Tim Sparks, and our show is sponsored by Sparks Financial Group right here in the heart of the Bluegrass, Lexington, Kentucky. Today we're going to be talking about the annuity upgrade opportunity while supplies last. When rates are up, it's a great time to be at least looking at these instruments for what they do and understand what they do. You don't never invest your money in anything if you don't understand it. I think a lot of times we're roped into buying something, then we regret it later. The worst thing you can do, and that's including annuities, stocks, bonds, or any kind of instruments out there, you don't want to be investing your money in something and then regret it because not enough was disclosed to you, or maybe there was some kind of a misrepresentation. Keep in mind, annuities are the most misrepresented and most confusing, complex product there is in America today, easily. But yet people are investing their money into them. $300+ billion went into them last year. Why is that? Well, it could be for a lot of reasons. I mean, it could have been that, it could have been because the interest rates are up and people saying, well, if I can not have to take a lot of risk and get a moderate return, then why not? They could have been convinced because, they've owned annuities in the past. Maybe they renewed them because they renew just like CDs. Or they could have came across an advisor that's primarily what they do in their practice is they basically convince people to buy annuities. With us, we deal with individual stocks and individual bonds. That's our primary tools that we use. Why? Because you can't beat inflation primarily with annuities in of itself. An annuity is just a tool. And can you get them for preservation? Yes, but you have to understand how they work, but whether it makes sense to do that or not. Some annuities have fees. Other annuities have no fees. But at the end of the day, you want to be able to purchase what you're looking for, and annuities have benefits linked to them that stocks and bonds and the counterparts do not. Because people ask me, well, what do you think? I mean, we do an allocation meeting when somebody hires us, and first thing we do is we cover insured instruments. Well, insured instruments have some kind of a guarantee from certain risk. It's in addition to what you actually own. Like if you own a corporate bond, you have no guarantee, right? Because you got default risk. When we're looking at insured risk, you're looking at FDIC insured CDs, for example, or insurance companies. You got fixed annuities. They're guaranteed by the insurance company. You got U.S. Treasuries, which are guaranteed by the full faith of our government. Those are what they call guaranteed instruments, and they are also somewhat insured. Reason we cover it because I don't know what the person's thinking. At the end of the day, it's their risk, and their money, and we're not here to impose our opinions. We're here to service them at the capacity that they want something, not at the capacity we want them to want. Because again, if they want safety, then they're going to see that as available to them, and not me just actually undisclose it to them and just talk about just stocks and bonds. Because some people don't like the risk of stocks and bonds because they are just nervous about being in the stock market. So we cover everything. So if you would like to know if you can upgrade your annuity, in other words, is there a way to upgrade your annuity? Is there a way to even sometimes overcome the penalty? There's only one way to find out, and that is call 888-930-1080. Again, that's 888-930-1080. And you will set up the call, Allison in our office will set up a call with myself, and we will have a phone call first before we even go to the next step, and that is to be able to look at your statement to be able to determine if it even makes sense. Always have a true fiduciary look at it, because a true fiduciary would have to give you the right advice. There's sometimes it does not make sense. Sometimes it does make sense, but you've got to be able to know the path before you take it. And again, if you would like to know more about how to upgrade, then call 888-930-1080. You're tuned in to the Retirement Income Source. This is Tim Sparks, and today we are talking about annuity upgrades. I ran across a client several years ago that had about 4 or 5 annuities as part of their portfolio, in addition to stocks and bonds and other tools. A pretty wealthy lady, widowed, and that sometimes when you purchase annuities, of course, the client probably doesn't know one way or the other whether they purchased the right product or the wrong product. But sometimes advisors will just sell somebody something just so that way they can just provide them some safe money or whatever, not even thinking about the return or what even the client is looking for. This particular client wanted to basically leave as big of a legacy as possible to her kids. Now, she didn't want a lot of risk, but in particular, a couple of the annuities that she had, the returns were, on the high side, she may be lucky she makes 2%. And it didn't make sense to me. I mean, even during this time, this client, if they would have known that there was even death benefit type of annuities out there that paid as high as 7% guarantees it's a benefit account for the purpose of death benefit, then she probably would have been okay, and I would have told her that she needs not make any changes. But since I knew that she needed to, she was looking more for legacy, then it made perfect sense to be able to make that change. So yeah, she paid a penalty, but we overcome the penalty with the bonus and again, this was more of a death benefit type play. And at that time, it wound up, and she still has that annuity today, and now it's doing exactly what we said it would do. She's taken out about 3.5% or 4% because of the required minimum distribution, but the guarantee death benefit base that it has inside of it internally kind of works like a life insurance policy, but it's not tax-free, actually is compounding at 7+% each and every year. So she's still growing in that particular type of account. So keep in mind, upgrading can sometimes means that you may not need the money. So if you don't need the money, then sometimes the benefits of annuities are higher than any other instruments out there today other than life insurance. So again, it has to make perfect sense. So we've come up to the end of our show, end of our hour, and I want to let you know get one more opportunity to be able to reach out and get our free book, The Retirement Income Shift, written by your host, Tim Sparks. Just came out, Amazon bestseller, 1 week after the release. And it talks about income first methods, growth second. Why is that important? Why? Because most people got two problems when they're in retirement. They need income and they need to beat inflation. You do that by not spending principal and focusing on income first. And you can do that by actually having stocks that pay you income. Therefore, you got stocks that grow up in value over time. That's the value of the stocks itself that you own. And then you just basically comfortably live off the dividends that it pays. It's a lot better than living off growth and spending growth every year, which means you're selling shares. When you're selling shares, you're diminishing your assets slowly but surely. It becomes a cancer that later on down the road gets bigger and bigger, and it becomes a problem that you're probably going to regret when maybe it's too late. Especially worst case scenario, if the markets took a big dip, then and you continue to sell your shares, you're going to sell them at twice the value than they were when they were at an all-time high. So with that being said, if you're one of the first 5 callers of today's retirement income source and you would like to get this book, call 888-930-1080. Again, that's 888-930-1080. And we'll mail this out to you. Again, if you're one of the first 5 callers, free, no obligation book, 888-930-1080. You've been tuned in to the Retirement Income Source. This is Tim Sparks, and we appreciate you listening today. I hope you learned a little bit about annuities and upgrades. Interest rates are higher than I've seen them since 2006 or 7. That's been quite a long while ago. When rates come down, the opportunities are going to diminish. So take advantage of them while they last. Thank you for listening, and we look forward to next week for some more great information.